This is part 3 of Building Wealth for Software Engineers, and we're going to talk about taxes today and how taxes work. So just to be very clear up front, I'm a software engineer. I'm not a tax professional. This is not intended to be tax advice at all, and it's meant to give you some basic understanding of how taxes work. If you want to learn more about taxes, you can go talk to a tax professional. Okay, so we talked about increasing the income. Now we have to talk about taxes, because as a W-2 employee, you're basically having to pay a lot of your income in taxes. All those numbers I talked about before, 500,000, 700,000, you're not actually getting that in your checking account or in your bank account at the end of the day. Close to half of that might be taken away due to taxes. And so you kind of have to understand taxes and the implications of that. So taxes are going to be one of your biggest expenses. If you're just starting out earning $200,000, that is going to be close to 35% of your total income. So that's $70,000. That's like the average household income. You're paying that much in taxes. 20% of that goes to federal. 8% is going to state and city. In this case, I'm talking about New York City. And then payroll taxes are somewhere in the order of 7%. So these main taxes, income tax, Medicare, Social Security, they are taken out of your paycheck. They're withheld. And so with the income taxes, generally, the more that you earn, the more you're going to have to pay in taxes. And there's various percentages for these. At E3, you're paying about 20%. Then for state, it's somewhere around 8 or 9%. And then for city, it's like maybe 3 or 4%. So these state and local tend to be about the same percentages. But federal, it can go up quite a lot, depending on how much money you have. And then with Medicare and Social Security, which are used to fund programs, like government programs, these are generally pretty fixed. So Medicare taxes is a fixed 1.45%. There's an additional one when you earn a certain amount of money, you'll have to pay more Medicare taxes, but that's a minor detail. And then for Social Security, you're paying 6.2% up to $168,000. This is actually capped right now, and you're not paying any Social Security over that amount. There's a big difference between tax withholding from your paycheck and taxes paid. At the end of the day, what's happening here is that the US has a pay-as-you-go sort of system for paying taxes, which means they don't want you to just pay once at the end of the year. Each quarter, you're sort of expected to pay the taxes that you're owed based on your income for that quarter. The way that this works for employees is that it gets taken out of your paycheck with each paycheck. So you're kind of always paying as you're going along. Now, you can think of these withholdings as like prepayments for your estimated taxes. So you're going to get to the end of the year, you're going to look at what other income streams you might have had during that year. And then those other incomes with your income from work are going to be added up together. You're going to figure out how much taxes you own from that. And then that final number is you're going to subtract out what you've already prepaid. And if you paid more than that money that that taxes that you're owed, then you're going to get a refund because you paid too much based on what you owe. And if you did not pay as much in your tax withholdings as what you owe, then you're going to need to pay the balance of that or the difference of that at the end of the year. So that's going to happen around the deadline, which is around April 15th. Okay. So federal income taxes are going to be the biggest part of the taxes that you're paying. If you remember, for a $200,000 income, it's about 20% for federal, out of like 35%. So like a little more than half of the taxes are going to be federal income taxes. As you go higher in income, let's say $400,000 or $500,000, then it's going to be an even bigger part. And so the taxes that are calculated, it's based on how much money did you earn from your job or from other kind of income sources. They're going to add any short-term capital gains you have and apply a deduction. So reduce that number by some other number. And then this kind of what your taxable income is gets multiplied by a set of marginal tax rates that go up the more income that you have. And then if you have any income from long-term capital gains, those income will have a different set of tax rates applied to them. And then at the end, you kind of subtract out any credits that you have. This could be for like things like childcare and stuff like that, or education. And that ends up being the amount of taxes that you owe. So there are these two main categories of income. And it's really important because they end up being taxed differently. So the income from work that we've been talking about from your job, this is going to be considered ordinary income, kind of like short. You can think of it as like income from work that you're actively having to do. So this includes short-term capital gains, which are basically when you sell something for more than it's worth within a year of buying it, then that is considered a short-term capital gain. If you sold something for more than you bought it for, and you held on to the object for more than a year, that would be considered a long-term capital gain. Your dividends from your stocks will also be considered ordinary income if you've held the stock for less than a year. There's interest from savings accounts and stuff like that. If you won money gambling, this gets included in here. Basically, like any other income, it's going to be on this scale. And this scale, starts quite low at like 10%, but then can go up to about 37%. With long-term capital gains, it tends to be much less. So this is really like the difference of what you got for selling something, let's say a stock, versus what you paid for it. The difference of that is the capital gain. And this gets taxed at a much lower rate, between 0, 15, and 20% federally, compared to up to 37% federally. That's a big difference. And yeah, there's also like kind of special rates for other things like real estate and collectibles, but that's less important. It's less common, I guess. Okay. So these are taxed at different rates. If you have $200,000 of income, your marginal tax rate is going to be 32% versus a 15% rate for long-term capital gains. That's almost like double, like 17 extra percent that you have to pay for income from work. And if you're making $400,000, that goes up to 35%. You also don't have to, when you have income from capital gains, you don't have to pay payroll taxes, which are that sort of like 7% for Medicare and Social Security. With tax brackets, so the dollars of your income are taxed at different rates. It starts at 10% and it can go up to 37%. If you move up from the quote unquote 34% to 24% to 35% tax rate, it doesn't mean that all of your money is taxed at the new rate. This is a common misconception. It's just that the last dollar that you earned is taxed at the new rate. The first dollar for everyone is taxed at the same rate of 10%. And we have this progressive taxation where the more that you earn, the more able you are to contribute to your taxes to society. So we ask more from that. There are things that help you to reduce how much taxes you pay. These are called deductions and credits. For deductions reduce your taxable income. And there's two types of deductions that are typically used. One is the standard deduction, and one is the itemized deduction. So you get to reduce your taxable income by the greater the two of these. And most of the time, if you don't own a home, the standard is probably going to be the larger number. So I think the standard was, around $12,000, $13,000 maybe recently. And if you're looking at your itemized deductions, what are you actually adding up? It's basically like a list of deductions that you can add up. And if that's greater than your standard, then you would use that. So what are you itemizing here? It's things like state and local taxes, up to $10,000. This is a recent change in the 2017 tax code that is going to revert at the end of 2025. This includes property taxes and income taxes. Then there's things like charitable contributions, which is another itemized deduction that gets added to this kind of list. And another big one is the mortgage interest deduction, which also gets added to this list. Okay, so that kind of reduces your income at the beginning. So let's say that your tax rate is a 35% tax rate. If you contribute an extra, let's say, dollar in charitable contributions, and your itemized deductions are greater than your standard, then that extra dollar that you contributed is actually going to save you 35 cents on your taxes because you've now reduced your income by $1. So that's you're getting basically, that contribution is reduced by whatever your tax rate is. If you have a credit, that's actually going to reduce your taxes by the amount that the credit is for, like 100% of the credit. And a couple of those examples are the child tax credit and a foreign tax credit. So because you're getting 100% here and you're getting like your marginal tax rate here, if you can choose between a deduction or a credit, you got to choose the credit. And that happens with the foreign tax credit. Okay. So the numbers, the thresholds for how much you pay and what the marginal rates are that you pay will change based on if you're married and if you have dependents, and also like how you're choosing to file. So if you're not married and you have no dependents, then you're just single. If you're not married and you have dependents, then you're called head of household. If you're married, you can basically choose between married filing jointly, which is probably the more common choice, and married filing separately. There's different rules for all these different statuses for your marital status, and that'll apply different rates to your taxes. So for example, these are the marginal tax rates for your income, and they will change based on what your status is. So let's just look at single and married filing jointly, because these are going to be the most common two groups. So let's say if you're single and you were earning $200,000, then the first $11,000 is going to get taxed at 10%. The dollars between $11,600 and $47,000 are going to get taxed at 12%, and so on, until your last dollar is going to get taxed at 32%. If you were married, for example, then your $200,000 would get taxed at 10% up until $23,000. Between these two numbers, you're going to get taxed at 12%, and your actual marginal tax rate will only go up to 22%, assuming that your spouse or partner doesn't make any money. So this is going to be a reduction over what this rate is. So that's why it matters, like what status you are. And this is the same idea for capital gains. So if you're single, your capital gains are going to be taxed at 0%. These are long-term capital gains. They're going to be taxed at 0% up until your income, if your income is less than $47,000. And if it's over $47,000, then they're going to get taxed at 15%. It's actually a little bit different because your income directly will determine what your tax rate is for all of the long-term capital gains income, unlike the previous situation with the marginal rates, where if you have an extra dollar, that's not going to change the rates for the dollars previous that you earned before this one. Whereas if you go across this threshold from $47,025 to an additional dollar, then all the long-term capital gains are going to get taxed at the 15% number. So this is actually quite important in terms of which bucket you're in for this number. And next, we're going to talk about how to minimize those taxes now that you understand how taxes work.